April, good to see you. Today we have a really important question. Is the 60-40 portfolio dead? I'm hearing a lot of rumors right now. I want to talk about why it may be and maybe some options to replace it. Long term, the bedrock of investing, the 60-40 portfolio recently had its worst monthly slide since early in the pandemic. Normally you would see an annualized return of about 10%, right? So how confident are you right now in the 60-40 portfolio?
Well, Erin, I don't think it's dead, but it's getting pretty close. I might consider it on life support and
Yeah.
really needing some help from things that are not traditional and not a buy and hold strategy. And times like we're in right now, where you see volatility across the board, whether it's aggressive or conservative allocation, and we see a high correlation of stocks and bonds, meaning they're both trending in the same direction. They're both moving in a negative manner right now. There are alternatives that need to be considered.
Okay, so I want to kind of drill down into this to understand why during periods of high inflation right now, why things aren't going well. And you supplied this chart because, of course, you are always a student, April. I know you, you're always studying. So what am I looking at here, and why is this important to those retirees and pre-retirees?
Well, when you're in the working phase of your life, we call that the accumulation period.
Mm-hmm.
And you can afford to have the volatility of the market because you have the time to make it up. And typically during that period of your life, you're contributing. You're not taking assets out. So that really has to change. There needs to be a shift that takes place as you prepare for those years right before retirement and you head into retirement, into preservation and distribution. We can't use the same rules that once worked when we were working and contributing. So what we see right now and what we've researched along with our investment committee at Brookstone is the trend that is concerning, quite frankly, for those who do not have alternative strategies in place. And unique to this period of time right now, if you look at the last year in that first column there on the chart, what you'll actually notice is that the more conservative that your buy and hold portfolio has been over the last year, the larger your losses.
Mm-hmm.
And that is not something that we always see. But again, when we see this high correlation of stocks and bonds and this level of volatility, it can certainly happen. And we see all of those portfolios across the board in the red for an extended period of time now.
Mm-hmm. And you and Reed Financial, you specialize in helping pre-retirees and retirees navigate this tricky period. And you touched on it earlier. This is all about having the correct withdrawal rate, because if you don't, it can be really devastating in retirement. And this is something here where you might run out of money before your retirement. That's so scary.
Right. And you know what a lot of times people focus on and even industry will focus on is the rate of return. What
Mm-hmm.
rate of return am I achieving year over year when making decisions about what to invest in? What are the historical rates of return? And the chart that you just pulled for us here is one that we use frequently when we're talking our clients through portfolio design and construction, because the rate of return is not what matters the most. What matters the most is the sequence that those returns arrive in. So what I mean by that is if you look at this chart, the red line and the green line represent the same average rate of return. And that might make you kind of scratch your head for a moment when you look at this, because what you'll quickly notice is a 13-year time gap,
Right.
where in that second scenario, that red line, the only thing that's different is that the withdrawals start in a negative market. So if you are taking withdrawals from your portfolio and the market is draining your portfolio as well, you can run out a lot quicker, even if the average rate of return is the same. That green line, the only difference is that the market had a strong few years towards the start of that distribution phase. And the difference is pretty remarkable, more than a decade of income. And the only thing that's different is the sequence that the returns took place in.
Yeah. It's so important, and retirees have so much to juggle. April, this was really helpful, but I think it underscores the importance of kind of working with a professional, because there's a lot going on there. If somebody's watching this and they'd like you to take a closer look at, how to properly diversify their portfolio to probably last 25 or a 30-year retirement, what's the best way to reach you?
You can visit with us anytime online at theretirementfamily.com, or feel free to call either of our offices in Suwanee or in Snellville.
All right, perfect. April, thank you.
Thank you, Erin.